My name's Ed Croft. I am founder of Stockopedia, and lots of new faces here. I just wanted to quickly ask, because I presume some of you probably don't know who I am or anything, so can I just have a quick roll of hands of who are currently subscribers to Stockopedia? There's probably about a third of you. Okay. For any of you, it's always difficult at these shows to know how to quite pitch it. So you will have seen some of this material before. I am going to be showing people how to build a portfolio, a little bit about the Stockopedia service. You know, we've been doing Stockopedia service has been a real labor of love for me myself. I was a stockbroker in the city, big banks, Goldman Sachs, and then I became a private investor, and I just found it, I couldn't find what I needed on the web, and so I started this website. One thing led to another, and we've got a whole company out of it. And we've been doing really, really well. And subscribers, you can talk to subscribers on the stand. Our sort of research and processes have really helped subscribers build significantly market-beating portfolios, and I'll be sharing some of the results that we've had. I think it's just the most excellent tool there is on the web. I am hugely biased. We grew from in early 2012, we launched the initial service. It was a bit buggy. It was a bit, but it worked, and it was we had 2,000 stocks coverage. In the next year we expanded it to all of Europe. A lot of people never invested in European shares before, and now lots of subscribers invest all across Europe, and Europe has had wonderful returns for equity investors. There are more costs with a lot of brokers. Your brokers, Hargreaves, etc., can make it a bit more expensive, but there are often better returns elsewhere. Last year we launched a US service, so we've expanded the coverage to the US, and this year we're going to be very soon launching Singapore, Hong Kong, Australia, Canada. So we're increasing all the coverage all the time. Now, 60% of our subscribers only subscribe to the UK, and in the UK market there are 2,000 shares where you can actually find exposure to all the best sectors of the world. So you don't think you need to go internationally, but I'll always encourage you to upgrade because you will pay us more. Anyway, disclaimer, of course, we are a DIY site. You will see stocks in here. This is not investment advice. People have been saying that all day, but you can come on and use the platform and make your own decisions from it. So we call it DYOR, do your own research, but our ranking systems are getting a lot more visibility amongst investors because they've really been working. So a lot of people are using them to guide themselves away from what I call story stocks into the better stocks in the market. Okay, I'm going to quickly rattle through before I show you the site. About 5-10 minutes max on site philosophy, because this really comes from a long history of my own investing. I've always been a data guy, always believed in the power of statistics to beat the stock market, and was always, but I found that I fell into a whole load of traps in 2008 like everybody else, and having found that I put my portfolio in 5 stocks, and 70% of my portfolio in 2 of them, thinking I was a genius and they'd gone up 4 times, found that they actually ended up like halving, and it was a disaster. 2008 was really, really bad. So it led to a complete rethink of how to go about investing personally, and the site development has been a huge research process by the team that has grown over time, and using all the academic research that is used in hedge funds, etc. I have to say it's been, and I'm going to be showing you how you can build properly diversified, high probability portfolios on the site. So that's a little personal story. Now I always say you get 2 types of investors. You get the stock pickers, and then you get the sort of what I call systematic investors, hunters and the farmers. Now, I am more of a systematic investor these days, but I used to be a stock picker. Most people, 80% of people using the site are stock pickers. So they use it to pick stocks individually. Benjamin Graham was the tutor of Warren Buffett, and he became a very wealthy man. And I love this quote from him. He says, "Try to buy groups of stocks that meet a simple criterion for being undervalued, regardless of the industry, with very little attention to the individual company. It seems too good to be true, but all I can tell you after 60 years of experience, it stands up under any of the tests I would make up." We've been testing this philosophy, and it absolutely does stand up. Buy good quality companies and buy a whole basket of them, and it beats the market. Now, a lot of what we're going to talk about ends up there's a lot of statistics on the site, and a lot of what we do is very intimidating to novice investors and rather wonderful for more experienced investors. So some of the philosophy, though, I think a lot of the jargon in investing is designed to put investors off. And I think it's a real shame, because you talk to somebody about a PE or a price to book, and a lot of people's eyes glaze over. And really what works in the stock market is very, very, very simple. And it gets crystallized in what we call the stock ranks, which are on the top of every stock report right here. And we use all the other data, which if I've got time, I'll explain a little bit of, and we pull it all the valuation ratios get pulled together into what we call the value rank, same with the quality factors into the quality rank and the momentum rank. And they all rank from 0 to 100, with 100 as best. And they blend together into what we call the stock rank. So quality, value, momentum, QVM, and right in the middle at the crossover of all three is where the stock rank is. So basically, you can think about this in terms of very, very simple, straightforward terms. In bigger baskets, in portfolios of shares, cheaper shares tend to beat expensive shares. I mean, this is like going to the supermarket. You know, you're going to buy bargains, right? It works. We can measure the value of a share against lots of different dimensions, but you can measure the price of a share against what it earns, price to earnings ratio, dividend yield, price to cash flow, what it owns, price to book ratio, and some other measures as well. And what we do is we rank all the stocks and we blend it all together. And if you create a portfolio of all the cheapest shares in the market, according to those measures, track them over time, this green line shows the top 20% cheapest in the market. You can see a significant outperformance against this red line, which shows you the most expensive 20%. So cheap beats expensive. Number one rule. Number two rule, quality. Good stocks beat junk stocks. So profitable, high margin, cash flow earning stocks, low risk stocks have a tendency to beat the opposite. You know, the kind of stocks which always raising money from investors, always promising something tomorrow, but always making losses. That's called junk. This is the quality set 20% of the market. This is a UK market. That's a 40% return over 2 years. And this is the most expensive set of the market. Sorry, the junk set stocks in the market. You can think of a lot of E&P explorers, a lot of blue sky AIM stocks, the kind of stocks a lot of people are attracted to but shouldn't be. Third rule is momentum. Leading stocks beat lagging stocks. And I'm going to rattle through because I really want to spend plenty of time on the site. But a classic example of why momentum works is this old case study of David Stevenson at the FT, who wrote about Dark Group, which he found on the Stockopedia website at the time. And he said, I let this one get away. And he wrote about it right there on that date. Now, who would buy a stock that's just gone up that much? Like almost doubled from like a few months earlier. Who would honestly do that? And he didn't. 3 years later, Dark Group has done that. Now it looks pretty obvious to buy there, but you know, that's why momentum works. People are psychologically predisposed not to buy stocks that go up. But the only way you can buy a stock that goes up by that much, like 10 bagging in 5 years, is to buy stocks that rise. So momentum is a very, very, very important factor. And of all the three factors we talk about, it's outperformed, it's done the very, very best. So this is the stocks that rise and where the brokers are increasing their numbers. And that's the stocks where the prices fall and brokers cut their numbers. So anyway, we put it all together. I call it QVM, quality, value, momentum. So quality, value, momentum. Good, cheap, improving stocks. Robert Haugen, a famous professor, called these kinds of stocks super stocks. They are kind of stocks that nobody likes buying, and that's one of the reasons why they actually do very well. And the opposite I call sucker stocks. Risky, expensive, deteriorating stocks. It's not rocket science. It's plain common sense. The market should reward good, cheap, improving shares, right? Should not reward these kinds of shares. And as we see, the overall stock rank has done even better than the other stocks in the market. So this gives you, that's a 67% return to the top 10% of the market ranked in our system. That's the FTSE All Share. So anyway, that gives you a little bit of a breakdown. And before I show you the site, I'm just going to quickly show you this because I think this is so important to understand. Investors love sucker stocks. This is what I'm going to draw a bubble chart here. Goes from junk quality on one axis, value on the other axis. So you have good stocks up here, good quality stocks, and cheap stocks over here. So good cheap stocks should outperform. Down here, you have expensive junk stocks, right? They should underperform. Great investors have portfolios that are up there. And that's aligning with the payoffs that are available in the stock market. And that's what Warren Buffett does. He buys good, safe, cheap stocks, right? And that's what we pick up in the Stockopedia screens and the ranks right up in that corner. If you look at the most discussed stocks on bulletin boards in the UK, that's how they look. So all the punters that you will find are talking about stocks in the wrong part of the market. And I think this is just so important to understand. The other thing is, generally you find the stocks up here that are actually in that quadrant that people talk about are often really controversial. They're like sort of Globo and other stocks like that. But I think this is such an important idea because if everyone online is talking about the stocks you own, or you find your whole portfolio is like this, it could be a problem. So there are dismal odds of picking up really good stocks online in discussion boards. Anyway, I'm going to show you the site and how we use these ideas on the website, because that's really what it's all about. So I just cleared that. So the Stockopedia website is at stockopedia.com, and we do top-down analysis and bottom-up analysis. You can't trade through the site. It's just a research tool and a research community. We have lots of subscribers, and everyone talks on the site. I'll show you that. We have editorial staff, the famous Paul Scott, who's presenting on our stand after the show, and all the other editorial team too. So we're not just a data site, it's all online. You don't have to install anything, you just go online, and I'm going to show you how to build a portfolio just using the ranks. And then I'm going to show you a little bit more advanced, some more advanced ideas. So firstly, you can either use this top-down to build a portfolio, or you can use it bottom-up to analyze a stock. I did show you a stock report, and I'll show you a few more of those. And if you really want to go into the stock reports, go on the stand later with Paul Scott. He'll be showing you some of his favorite stocks. The portfolio, I showed you how well the stock ranks have done, and you think, well, okay, there's 180 stocks in each one of those lines. I wrote a blog at the beginning of the year, which is called the New Year Naps, and it was based on all these ideas, but it picked 2 stocks from every sector. There are 10 sectors in the stock market. I picked 2 from each of them, the top 2 highest ranked stocks, and put them in a portfolio, and it's up 34% year to date. The only trade has been because Catlin got bought out. So this is a heavily diversified portfolio. You can see this portfolio. These are all different sectors: telecoms, healthcare, financials, consumer cyclicals. And you can see the sector weights and all the allocation. We can also look at the performance since January the 1st. And I was very nervous when I put this portfolio together because at that time, all the market was actually well under where it was last March. And if I show you the valuation, it's done extremely well. So, okay, next year might not look like this. I'm feeling more confident now than I did in January, which means if you feel more confident, it's normally a bad sign. So I felt very nervous in January. I'm going to learn to trust my nerves. Nerves are a contrary indicator. So anyway, how did I build this portfolio? I literally gone to the ranks, top stock ranks, and this list gives us, as default, all the stocks above a 10 million market cap in descending stock rank. So we know they're all high QVM, quality value momentum stocks. And you can use these filters on the side to filter. So if you wanted to find stocks that are in a specific sector, you click sectors, energy sector. Sorry, I'm actually, 1 minute. I want to make sure I'm on the right edition here. Okay, sector. Do you know what I've realized? Somebody is presenting on my login on the stand over there. So if I start fighting because this keeps switching to the American stocks, that's why. Okay, so here's the 2 top ranked energy stocks in the UK market, NWF and Lamprel, a 79 million market cap and a 419 million market cap. You can hover over these, you can have a little look at the charts, have a little learn about the stocks, and if you see when you click these checkboxes, you can add it to a portfolio. So there's my stock market show portfolio. I'll add it, and they're in my portfolio now, straight like that. I can go back and do the same thing again in a different sector. I can go back and go to basic materials. There they are. International greetings, Robinson, 2 stocks. Okay, this is what I've done. I'm not saying you should do this, but I'm just illustrating how this was done. And once we've done that a few times, of course, you can even go and well, I want more large caps. So you filter for large caps, right? And there you can see some household names: Barclay, Royal Mail, Persimmon, 3i. I own all 4 actually. And sector, you could go and look in. Let's have a look at consumer defensives. And there you go. You buy a couple of consumer defensives, bang those in your portfolio, and you've got some large cap consumer defensives. So you can quickly put together a portfolio of stocks. Now, if you're sort of testing out and you want to track it, you can just track it. Without putting in any trade details, you can click the analysis tab, and you will see a 1-year performance history. This is taking those stocks and looking backwards. But you can use these tools any way you like. You can, of course, if you were to go and start dealing in these shares, you can go and add transaction data. So if you've bought some of these shares, I don't know, whatever you have, however much you have bought, you can save the transaction data, and then you'll start getting a valuation. And that valuation will get logged every day. I'd love us to synchronize this automatically with the brokers, but unfortunately the brokers' technology is always seems to be too dated. So please encourage your brokers to be more open. But that is essentially how I build my own portfolio. So, and my own portfolio, I have literally done that, and I'm up 40% this year to date, including with the recent downturn. So it's been a very profitable, for me, and I know for a lot of subscribers. I also use this I do spread bet, and I know on the main stage we were talking about spread betting is dangerous, but if you do spread bet, you can use clicking here to look for the lowest ranked stocks. And I generally will look at large caps that are very low ranked to go short on as a hedge. Not because because sometimes if you're only long the equity market, you can be worried that, what if it falls 20%? So I like to use spread betting to go short and hedge, but that's another concept for another day. But I think you can see how quickly you can find shares which are have the kind of profile, this good quality value momentum shares, which could be suitable to you. Now, a lot of people some people, for example, don't like momentum. And so they will actually use one of our different ranks called the QV rank for quality value stocks. So you can click that, find good cheap shares, which not taking momentum into account, etc. And you can see this is a very, very powerful filter. Now we can take this further. I don't know if anyone was in the dividend presentation earlier, but let me show you how I find dividend shares. You can go from the stock ranks. And you can save to, let's say we wanted to find large cap dividend payers. We click large caps. And we can then click this button, save to my screens. It exports it into the screener where I can now, you can see there's an edit button here. And we can add more sophisticated rules. So if you're someone who likes fiddling with data, you can go in and you can go, right, I want to add a rule, which is the yield. And I want my yield to be greater than 3%, I think we did. Qualifying shares. And these are all 3% yielding shares and what we also need to do is let's add a market cap filter. So we find stocks above a certain size, so we just look for large caps. So these are the top 3% plus yielding stocks with very high stock ranks. My rule of thumb is I always only invest in 80 plus stocks. So Barclay, Royal Mail, 3i, Imperial Tobacco, etc. And if you actually looked at the other end, you would find, you just want to avoid low ranking stocks. That's my philosophy. Of course, once you're on these tables, a lot of people don't like tables. A lot of people like charts. We have a little nifty button here called, I call the view bar, which lets you look at your lists as charts or indeed as different visualizations. So this is that screen of high-yielding shares as charts. And of course, the really fun one is this one on the right, which we call the bubble charts. I showed you about those. And that shows you all those bubble chart, all those shares in the bubble charts. So there we go. You can do those analyses on your portfolio, etc. Now, I'm not going to show you too much of a stock report, but if I'll quickly show you. You can search Barclay Group. Let's go and have a look at one share. Obviously, you can click through from any list, from the stock ranks, etc., and go and look at a stock in more detail. As I said, my system is just using the stock ranks, but a lot of people like using a lot of the essential financial statistics are here. Things like the dividend yield, the earnings growth rate, price-earnings ratio. We call these the traffic lights. And they show you how this ratio compares against this company's industry and the market as a whole. The rule of thumb is if it's broad and green, that means it ranks very well for that metric. So it means it's going to be cheap, it will be good quality, or it will be growing. And if it's very red, it means it's quite, it's not good for that metric. So if I was to, and you start learning how to read these fingerprints. If I was to look at, for example, ASOS, I don't personally buy clothes from ASOS, but my daughter does. Who knows ASOS here? Only that many know ASOS. This is probably the greatest winner in the stock market over the last 10 years. I mean, but when I didn't buy it in 2004 at 5p, and it went all the way up to £70. So my 10,000 would have been worth £7 million. So I'm quite upset about that. Do you know the share I did buy? You won't, because it's gone bust. It was called Maduro Resources. It's a classic sucker stock. If I'd known back then when I was a younger man what I knew now, but I kept that one in my portfolio for like 5 years, and it 99% loss. And I didn't buy ASOS. I learnt what I know now much later. And this was always expensive, but it was what I called a high, it was for a lot of that time, it was a high QM stock, quality and momentum. So what I normally have a rule of thumb that I will only buy shares that have at least 2 or 3 of these indicators above 80. At the moment, ASOS doesn't fit my profile. But I was looking at this stock report because I wanted to show you the traffic lights. And you can see these are very red and thin, and it shows you that the stock is very expensive. But these ones are very green. These are return on capital, operating margins. These are profitability measures. So this company is insanely profitable and wonderful, but it's a great company and every fund manager knows it. So every fund manager wants to buy it. So it's really expensive and it's very volatile. But you can see how these things fit together. I want to quickly show you, because I've got only 6 minutes more. Could do this for hours. Okay, we have some really good. I try and do some writing on the site, but I do probably write a couple of times a month, and really enjoy it. Just never get the time. But if you go to the Discuss tab, you will see a sort of stream of articles. Some of them are user generated, so we have conversations in the community. It's generally subscribers who are talking about all kinds of different things. And then also you will find articles like Small Cap Report, and they've got slightly different symbols. Small Cap Report's written by Paul Scott. Paul is, I think, probably the most prolific blogger on small caps in the world right now. He writes every single day about 3,000 words. And you can see he wrote this 2 days ago, 6,000 reads. And you can see how much he writes. It's unbelievable. I mean, look at that. He just goes on and on and on. And you can see all of our community talks about stocks. There's 33 comments underneath. If you're interested in stock picking in small caps in the UK, this is the best place to be, because even if you don't use our tools, Paul does use all the tools, and he uses the stock reports for his decision making. But you can go through. A lot of people who don't subscribe read our blogs, because it's a good place to hang out and learn. And Paul's an accountant. Financial officer of a very successful retail company, and he knows all there is to know about how companies cook the books. So a lot of these comments, you find there's a really, really good stuff in there. And also, if you are interested in education, we have a lot of help resources on the site. So I'm really consciously trying to make this a very educational experience. So all the content goes, we gather our content into ebooks. They're all free for download. They're not very long. They're deliberately no less than 100 pages. How to make money in value stocks got featured in the FT. How to make money in dividend stocks. You can read them online, or you can download them for your Kindle, iPad. It's all here, or as a PDF, and even get an email course. So you can read it all online, all here. And all our blogs go into these things. And we also do webinars, and there's lots of video help too. I can't possibly sort of go into all the details. What I will say, though, is that if you don't subscribe, please, we do these. This is only the second conference we've done this year. We're in the middle of rebuilding the whole site. So we're not doing this very often, and this is the only time we're going to be doing this 5-day free trial with no credit cards. Normally, when people sign up, they hit a credit card paywall to take a trial. There's no paywall at all today. So you've got a 5-day trial. All you need is an email and your name, and we will send you a link. When you click the link and enter a password, your trial will activate. So once you get the link, if you're going on holiday, just don't click the link. Just wait till you get back, activate it when you've got a little bit of time. You can extend the trial for another 14 days once you're in. So if you find you're making use of it, you can extend and then decide if you want to become a subscriber. For the UK, there's a discount on at the show, £50 discount for a year. So the UK is about 150 for the year. You do it for 25 a month or 150 for the year. We also have international plans. If you're interested in Europe or USA, you can do that too. So please do take advantage of that, because I can't offer it on any other day. Also, on the stand, there's a list of 15 of the top stock rank stocks. If you want to grab, there's 100 of those. So please do, please, it would be great if I didn't have to carry those home. So anyway, and there's lots of other brochures and things. And I really do hope that everyone has a good look around, because I think this is great, and I think the community that's building is absolutely superb, and that's almost even better than all the other stuff we do. So if you want to get away from some of the grubbier parts of the market, we do no advertising, there's no spam, we're only paid for our tools and for our service. So please give it a go, and good luck. And I've got one question or two questions I can answer. Anybody? Yeah.
Can we just see some examples of charts on there?
Yeah. Okay. Well, I will let you know one of the reasons we are rebuilding. If I show you, for example, we go and look at Abcam. We've actually bought a huge new charting package. We do have a lot of technical indicators online, but the new charting package, which is due to launch in Q1, is way more powerful. And I'm hoping that we're going to be you can annotate it, you can draw on the charts, etc. I would say the charting is right now is one of the weaker parts of the chart of the offer compared with some of the others out there. I say the fundamentals are way better, but you can create charts, save your settings, and use them on the site. But in Q1, we have a way better chart package coming out. So just keeping you posted there. Yeah.
So the three rankings, those are kind of your proprietary formulas, yeah? Can you, how often do they update?
Every day.
Every day.
So,
can you chart them?
Okay, you can. You can. Well, no, you can't. Okay, you can dig around in the performance. So you can go and we've got various filters to look at the different ranks with some different rebalancing strategies and whether to look in buckets of 5 and 10. We've been storing the stock rank history for every stock in the market for the last few years, and the part of the redesign is to build that into stock reports. So at the moment, if somebody emails us and goes, show me the rank chart for this, we can do it, but it's not on the site. Yeah. So I mean, I can actually just show you how this works. So
And sorry, just one question. Where do you get your data from?
Okay, our data. I'll tell you our process. Our data comes from Thomson Reuters fundamentals. So it's income statement, cash flow, etc. We take raw fundamental data, and we take estimates, consensus estimates. Let me show you some of the consensus estimates data. So Thomson Reuters have a process that pulls in all the broker numbers. We pull them all in and we compute ratios based on that. So they give us like highs and lows. They don't give us the line item broker data, but we have this estimates package. we also put in price histories and then all the profile information and other metadata. And we compute all our ratios, statistics, ranks, stock screens ourselves. Oh, the other thing we do have is a big library of what we call guru screens. When we first launched, this was what got us noticed. But so, you know, if people followed the Slater Zulu principle strategy, we have models of all the classics of stock picking literature on there. And a lot of people use these, you know, to go and find. I mean, a lot of people, for example, Jim Slater had lots and lots of followers, and this strategy has done amazingly well in the last couple of years. You know, since we launched, actually the history goes back further than the stock ranks, and that strategy has done 127% since 2012. So it's been very effective. And you know, we've modeled lots and lots of books, and you know, sometimes we get letters from the people whose books that we're modeling. But you know, I always say to them, well, look, if you want to be off the list, that's fine. But and of course, what you can do is, if you're into something like Jim Slater's screen, there's a duplicate button, so you can copy it and edit the rules yourself, change them if you disagree with them, and you know, create your own version of these stock screens. So it's a really powerful set of tools. Any other questions? Okay, cool, thanks.